Don't do it, guys. Don't place trades based on what you see here. Please consult your own financial advisors and do your own due diligence. All right, with that said, let's go. It is Tuesday, September 25th. Only up about 50 bucks. Oh, it's yeah, only up about 50 bucks on the day. Um I was up as much as 35,800, but it dropped a little bit. So, I'll take the gains. It looks like I had a down day, but actually it's a bit of an up day. Yesterday ended at 650, now it's 690. So, all good. A few interesting developments that we got to talk about today, guys. Just a few. So, number one, the trades that I made. First of all, it was kind of a green day, but it was pretty flat, especially for me, taking into account everything, you know, no real big moves. Chemicals down a little bit. I needed to hover around $10. If chemical can hover around $10 like this, I'll be happy. That's fine. I'll just keep milking it. But let's take a look at the trades I made, and then we're gonna move on to our little discussion. So I have dividend spending. So here's what happened here. I sold some chemical puts for October 19th for $30 total, two contracts. So I actually sold them for the 9.5 price target point since chemical is already below 10. And we'll see how that plays out. So now I need chemical to really stay above 9.5. I'll be sad if it drops below. Um, what else did I do here? I saw the URA $14 calls. It's around $13 right now. So I'm betting that it's not gonna go over $14 by the time November 16 rolls around. So that was interesting. All right. Um, there's another put here for October 26th for $9.5 on Cameco. So I'm really going heavy on this thing because it is just sitting really flat, and I like that. I really like that because I know it's not going to go down to zero. I know they're intelligent. Look at this flatness. It's flatland, guys. Look at this. There's no valleys, no peaks. There's a little tiny mountain here. But it's pretty flat overall. It's not going anywhere, and I don't think that's going to change anytime soon. So I'm playing it. I'm going to sell time against it here. Okay, now, what are the big news of the day? First of all, the metals are just up a little bit. It's 10:56 right now p.m. on a Tuesday. Metals are up like 0.03% or something like that. I didn't have as good of a day as I thought I would yesterday. I only up 50 bucks. So we'll see how the rest of the week plays out. If reversal Tuesday isn't really strong, excuse me, if reversal Tuesday isn't really strong, what ends up happening is the rest of the week doesn't really play out like it's supposed to. Maybe it could be an atypical week. Atypical week. XK today was up for a little bit. It went all the way to 239. It was up as much as 4%. Dropped down on the day. I'm not worried. Not worried. Any other notable moves? Um, let's see here. I have SIG up 0.5%. Gas. Yeah, I mean, you know, no big moves. It's a pretty flat day overall. Now, what I want to talk about here is interest rates. All right, the 10-year interest rates are now at 3.1%. 3.1%. So that's actually really high, historically speaking, relative to what's been happening, especially in the last 10 years. Um, that's really high. So last time the rates started pushing up, they started crushing the stock market, and then the rates had to back off a little bit, and then the market regained its footing. So it looks like we're going to be heading into another one of those scenarios where the rates are now even higher than when they put a stop on the market in the beginning of the year. So, it might be even more aggressive. Like the market survived it, and yeah, okay, like the individual stocks are looking good. Apple looking good. All these stocks, Nike crushing earnings, whatever. Stocks are looking good, but this thing is still out there. A lot of, especially the S&P, maybe the top 15 stocks, not so much, but the whole S&P, they have debt. They have a lot of debt. They need new debt, and it's going to be more expensive for them to borrow money. Plus, on top of that, you've got to compare. You got to keep in mind that these rates are in competition with the market. Yeah, so if you could get 3.1% every year for 10 years, you might take that deal versus keeping your money in a quote unquote high or overbought or overpriced record high stock market. Might make a bit of sense. But what it tells me though, here's what I'm thinking, right? What it tells me is that let's do some drawing. All right, let's do some drawing here. Why don't we do that? So we'll go to scene. Okay. So rates are at 3.1% rates. Oops, that is not the symbol for percent. Okay, 3.1%. Oil prices are like $72. They're climbing steadily. Now they're not nearly at their all-time highs, but it's still high. Stocks, the market is at all-time high. You know, that's what we're gonna do. So what this spells to me, right? This combination of rising rates, rising oil prices, rising stock market at the same time means what? It means this. That's what it means. It means inflation. So, what are we going to do about that? Let's go to scene again. Sorry, not scene, window. So, whoa, did we lose picture? No? Oh, oh, okay, we'll just stay with scene. That's fine. Oh, I see. I closed down the browser, guys. I am so intelligent. All right, let's do this. Window capture doesn't want to work. Oh well, whatever. We'll just go like this. So, as I was saying, all that spells inflation to me. I, it, perhaps the market is going to start playing that same chicken game of chicken again, where as the market rises, the rates rise, and then the rising rates kind of crush the market for a little bit, but then the bonds catch a bid, and the rates go down, and because of the rates go down, then the market catches a bid, and so it's this jigsaw, going back and forth until someone wins, right? Last time, right here in 2018 January, the market ended up winning, right? It looked like it was heading down for a moment here. Look, it's a downward triangle here. It looked for a moment like it could be going breaking down. So people were wondering, right? Is the rates going to win? But eventually the market won out. People calmed down, and now we're all the way back in new highs again. So we'll see what happens this time around. The rates are now higher here today than they were back in January. So we got to keep that in mind. So there could be even more pressure. So I talked in the previous video why the higher rates have such a downward effect on emerging markets around the globe and other currencies, things like that. So we're not going to have that conversation here, but it also impacts the US market as well. Not in the same way, but the market has also has debt. These companies have debt, and they have to compete with the bond, with the 10-year. It's the benchmark yield in the financial world is what everyone looks at to see where rates are headed. Now, another thing that's going to impact the higher rates is what? Housing, right? Housing. Um, let's see if there's a housing ETF we can look at here. No. Okay. Real estate. Oh, there we go. So it's going to affect the housing market as well. All right. So right now it's pretty high. It's riding high, but it's why does it affect? Because mortgages, loans, plus there now this debt is also in competition with bonds. I mean, just think of it this way. Why would you lend to some schmuck to buy a house at 3 point whatever percent if you can get 3.1 from the government, virtually guaranteed, and you know government's always going to give you the paper back, whereas Joe Schmuck might not be able to give you the paper back. So it's in competition as well, and it's bad news. But so far though, no one's feeling it. The market isn't feeling it. It's just brushing it off. They're like, oh, no big deal. Um, Housing market's brushing it off. No big deal. Metal prices brushing it off, right? Let's take a look at GOD, right? Metal prices, they're down. 5 years look down, brushing it off. Nothing to worry about. Nothing to worry about. Now, on the surface, this makes sense that the metals would drop on higher rates because, zero yield versus 3.1% yield is worth. But if inflation is running hot at over 3%, then gold's actually beating the 10-year rate. It's beating it, right? So I'd rather get zero on my purchasing power per year than let's say a negative zero point 0.1 or negative 0.2%. So it depends on what, the inflation's running at. Now, to find out what the inflation is running at, you can look at the Fed's numbers or you can make your own calculations. But, depending on where you live in, I can tell you right now, inflation is a lot higher than just a couple percent over here in Silicon Valley, where I'm at right now in San Jose. It's crazy out here. Rents are going up like mad. People raising a few $100s per year on the rent. Um, like $300-400 on let's say a couple bedroom house or something like that every year. It's pretty insane. So that's just the rent. I go to In and Out. It's a really good burger joint out here. And I just look at the number one meal, right? And I remember 2011, actually kept track for a while. 2011, it was like 5.45 for number one, which is burger, fries, and a drink. Well, now I go, and some of them have it at 8.05. $8.05. Now you can work the math out yourself. I'm not going to do that. I'm not a good mathematician anyway, plus who wants to see that? But it's quite a bit from 545 to 805 in a matter of 7 years. That's a lot more than just a couple of percent per year. So go calculate that. I did some inflation math for you guys since 1999. We've learned that $1 equals $1.65 of today's dollars. $1 back then equals 165 today. That's just accepting the government statistic. But if you live in the area that I live in, man, you got housing. Oh man, like I remember back then you could rent a three-bedroom house, three-bedroom house for like $1,300. Right now you can't even rent a room for $1,300, and I wish I was joking about that. I would know. You can't even rent a room, all right? And you look if you don't have to share a bathroom with that room. Like it's just crazy out here. So inflation's running hot, everyday expense running hot. So oils now is on the rise again. So as you can see, gold is brushing it off. Market's brushing off the higher rates. Housing's brushing off the higher rates, right? People, no concern at all. People are just distracted over this trade stuff, and I told you guys trades don't matter really at all. It's just people being, they're being a little whiny, all right? Being a little princesses about it. Like, China, this is funny, a China article. Like, I don't have nothing against China, but, it's just the way they're portrayed here anyways. This article came out and said, oh, China is um, calling Trump a bully, and he wants them to stop bullying them, trade bullying them if they're going to negotiate. They're just being such princesses, like both sides, like the US and China, they're just being prima donnas. Like instead of saying, "Oh man, all right, let's remove all these barriers and stop being, twats about it." That's a weird word. Um, they keep playing this game, and it's just a distraction to the real problem, which is this rising rates. So we'll see what kind of excesses this rising rate environment reigns in. It'll be very interesting to see. But so far, man, everybody's just going. Everybody's just blind. It's like this fact doesn't even exist. So yeah, we'll see. You know, we'll find out what happens. But my guess is that markets are going to start rolling over pretty soon here. I'm not going to say tomorrow, but within the next few weeks, if we see this, especially if we see that 3.1% go up to 3.2, 3.3. I mean, we're getting into dangerous territory right there. These are serious rates. This is definitely like normalization for sure. All right, I've been talking a lot, talking my head off. So I'm gonna cut it right there, and I'll see you guys tomorrow. Hopefully something even more eventful happens that we can talk about. All right, peace out.